immortal line from the movie Jerry Maguire,
"Show me the money!"
well, that's what financial statements do. They show you the money. Every company, irrespective of its size, should prepare financial statements for every financial year. It is very important to maintain your company's financial statements, or you may even have to face the penalty of imprisonment. But don't worry, today I will tell you all about financial statements that your company needs to maintain to avoid penalties. Hello and welcome. I'm Ayeshri from Clear. We have assisted more than 4 lakh growing businesses. Do subscribe to support us and get a clear explanation of business concepts. Financial statements are records that disclose financial information about a company's activities and the current status of the business. In other words, it gives a true and fair view of the company's state of affairs. The Companies Act 2013 provides that the financial statements of a company include a balance sheet, statement of profit and loss, cash flow statement, and any explanatory notes. Now let's look at each one of these statements. A balance sheet portrays the value of assets owned and the liabilities of a company. It is a report version of the accounting equation, that is, balance sheet equation, where the total of assets always is equal to the total of liabilities plus shareholders' capital. Thus, assets is equal to liability plus capital. The 3 important sections of any balance sheet are: assets, this is a resource owned by the company to produce positive economic value. Liabilities, this provides a list of debts that a company owes to others. Capital or equity, this is the amount invested by the shareholders in the company. The statement of profit and loss or profit and loss account illustrates a company's total income, expenses and profits or losses over a certain period of time. A profit and loss statement also provides information on the company's operations. Companies must prepare the profit and loss account as per Schedule 3 of the Companies Act 2013. It is prepared by listing down the incomes and expenses to arrive at the profit or losses of the company after tax deduction. The cash flow statement merges the balance sheet and the income statement to highlight business activities including operating, investing and financing activities involving inflow or outflow of taxes. As prescribed by the Accounting Standard 3, there are 2 methods which can be used to prepare cash flow statements, which are direct method and indirect method. Whichever method be used, the end result under all 3 activities, that is operating, investing and financing, will be the same. It is a financial statement that offers aggregate statistics on all cash inflows a business collects from its continuing activities and external sources of investment. It also includes all cash outflows over a specified time paying for company operations and investments. However, the Companies Act 2013 provides 4 types of companies that need not prepare a cash flow statement. The 4 types of companies are as follows: OPC, that is one person company, small company, dormant company and private company recognized as a startup by the Department of Industrial Policy and Promotion. Explanatory notes annexed to or forming part of the balance sheet, statement of profit and loss and cash flow statement is also considered financial statement. The explanatory notes provide additional information explaining different parts of the financial statement such as risk, uncertainties or accounting policies that affect the company. I hope you are clear about what financial statements your company must prepare. If yes, please write company in the comments below. If not, let us know your query in the comments below and we will address them as soon as possible. So, what next after preparing the financial statements of your company? The Companies Act provides that the financial statements prepared for a financial year must be kept at the registered office of the company. The Board of Directors must lay down the financial statements for the financial year at the annual general meeting, that is AGM. The financial statement should be duly adopted at the AGM of the company. The copy of the financial statements along with all the documents required to be or attached to such financial statements should be filed with the Registrar of Companies in Form AOC 4 within 30 days of conducting the AGM. If a company does not maintain and prepare the financial statements as prescribed by the Companies Act, the managing director, the whole-time director in charge of finance, the chief financial officer, or any other person charged by the board for preparing the financial statements can be punishable with an imprisonment for a maximum of 1 year or with a fine of minimum of rupees 50,000 and maximum of rupees 5 lakh or with both. The basic objective of financial statements is to provide information about the financial health, growth and modification in a company's financial position that will be useful to a wide range of stakeholders in making business decisions. Thus, it is essential that you prepare your company's financial statements every year, not just to avoid penalties, but also to provide the true affairs of your business to shareholders and investors and gain their trust. You can also contact our experts for business or finance related queries by clicking on the chat link provided in the description box below. Also, don't forget to subscribe to our channel for more such informative videos and stay tuned for more updates.